Hello, I'm Peter Towers, founder and managing director of ESS BIZTOOLS. Welcome to the Accountant's Minute podcast. Boost business sale value for SMEs. Sounds easy, doesn't it? But in fact, it's difficult. But let's start with probably a widespread belief. It's a buyer's market. The vendor cannot improve the price offered. I don't agree with that myth. As a professional advisor, you are in a perfect position to influence how much money your client's going to get paid for their business. Because the sale of a business is not something that just occurs after 1 year, 5 years, 10 years, 30 years, and then a decision's made. It's something that can be planned right from the beginning when you first talk to the client, to discuss with them how they're going to prepare themselves for their ultimate exit from the business. Because most businesses are run by people who ultimately do exit. Some, of course, are developing the business so it can be handed on to their children and their grandchildren. But most of my comments are probably to the bigger group that ultimately want to sell. But the comments I'm going to make to you today also apply to the people who want to make their businesses part of their family inheritance, because the valuation of the business is also critical there. So when a client asks you for advice on selling a business, it shouldn't be a quick answer. It shouldn't be, oh, well, we just need to tidy up a few systems and I'll go through the documentation for you and we'll see what the best price you can get. That's probably the only option you've got if there's been no pre-planning. If the client walks into the office today and says, I've decided I want to sell the business and I'd like to have settlement within 3 months, there's really not much you can do to influence what the price is going to be. So there's a lot of rewards available for preparing for this day, which after all is going to happen to the vast majority of businesses. But as I said a little bit earlier, my comments will equally apply to one of your clients or a number of your clients who are wanting to leave the businesses within their family. So what can you do to increase the overall value of the business? It's having a system. It's thinking through what's going to happen. It's planning for the future. You need to talk to your team about what should be done. There needs to be communication with your client's team about the benefits of being able to have the business run without the owner being there for a month or so that a potential buyer understands that the business can run on its own. It's interesting to look at the customers. Are they loyal? Is there a customer advisory group? Is there feedback from customers? Or are people just buying from this business without any real thought? Maybe they're the closest business to where they live. Suppliers, are there strong relationships with the suppliers? Do the suppliers care for your client's business? The premises, well, they might need a coat of paint, of course, and that could be done within that 3-month period that I'm referring to. But what else needs to be done? Are they practical? Do they suit the requirements? Are they in the right zoning? Is someone going to devalue the value of the business because of something wrong with the premises. But then we come to the important things, I think, the systems within the business. Systems make the business. And this is why I think these comments should go back to the very beginning of your relationship with your client. Because I think accountants and advisors who help their clients plan for value, plan for the ultimate exit, rather than react to a client saying, I've decided to sell the business with no pre-planning at all. Those who have planned for this are able to make a tangible difference to their clients' wealth and to your advisory firm's reputation in the marketplace. Because people talk. People get to know what's been paid for a particular business. So what's needed? When you're sitting down talking to a new client today, you just decided to start a business or actually buy one, and you're talking about their ultimate exit. Well, that's facing up to reality, I think, and it gives you the opportunity to put in place great systems for the benefit of your client. There needs to be systems manuals developed for every operation in the business. They're documented, they're recorded, they're adjusted if need be. But it's one of the key points in determining an overall value of a business. Are there written systems? Or is it all relying on memory? Document the intellectual property within a business. I think we all underestimate the value of intellectual property in small, medium enterprises and accounting and bookkeeping firms also, I might add. But there's intellectual property in the business. Is it documented? What would happen if something happened to the owner or the CEO today? How much is embedded in the memory and would potentially not be available for the business? So it's important to be communicating to your client right from the very beginning the necessity to document their intellectual property. Now, it needs to be safeguarded, but it needs to be documented. And other people within the team at times need to be informed of the intellectual property, understand how it all works. The protection of that intellectual property is also important. So the business may have registered patents, or they may have decided they want to work with confidentiality agreements with their customers that people sign on to. Some people don't like patents, of course. Patents only last for 20 years, and that may not be long enough to really extract the full value from the research and development that went on in that business process. I think one of the most important planning aspects, though, is to embed into the culture of this business the concept that there needs to be a business plan. And the business plan should not just be prepared by you. I don't react very well when an accountant says to me, oh, yeah, I sat down yesterday and wrote a business plan. And I say, oh, yeah, and how much input did you get from the client and the management team? And they look at me and say, oh, no, I just went right ahead and wrote a business plan. Well, that's not good enough. I don't think it is. There were some government grant schemes 30 years ago that probably encouraged that sort of activity to be undertaken. But thankfully, the government that promoted those changed their mind. Business plans need to be the result of a collective think tank, where the leadership team in particular, but I like bringing all the team together for at least a few hours when doing a business plan so that we can get some wider views on certain things. And you will be amazed at times what comes out of that type of discussion from someone who probably most people don't even know the person's name or what they actually do. Could be a very young person, or it could be someone that's been around this business for many years, has seen it all, and they can make some interesting comments. So the business plan should be set and it should be signed off by the leadership team, I believe. I like giving them the biro and saying, well, there's the document, sign your names, the 5 members of the leadership team, because they should be making a pledge that they are going to implement this business plan. Otherwise, it's all been a waste of time. A business plan is not a glorified document to give the bank. It's a key driving document for the leadership team to use to guide the company on what the processes are going to be. And it should be analysed at each month's leadership team meeting and board of directors meeting to see whether there's been any variations, to see whether the targets have been achieved. It has to be a living document. And then we turn to budgets and cash flows. The predictive accounting reports is what we refer to them today. Budgets for all business operations, not just a consolidated, break it down into all operations. Key drivers, which is looking at the inventory accounts, the completed goods accounts, the debtors, the creditors, the work in progress, the capital expenditure, research and development, so that those key items can be analysed to see what was the budgeted amount of money to be invested in them. So the budget for inventory raw material was $200,000. So at the end of the month, you're looking at it and it's $300,000. Why? Why have we got that extra $100,000? Because that is going to affect the cash flow of the business. So the predictive accounting reports are the financial interpretation of the business plan. And then we've got the predictive balance sheets. So we're looking at the predictions for the future. This is what this business will look like at some future date. I think it's important that the concept of weekly reporting is embedded in the business right from the start. That's the big difference between larger businesses at the big end of town. Not that all small businesses don't do it. A lot of them do these days, thankfully, but a lot more could do it, to prepare weekly performance and profitability reports. Because what that forces the leadership team to do is to sit down and analyse why there was a variation, why the expected result was not achieved, because it needs to be investigated straight away, not left in the accounting system to go possibly for another 51 weeks. And then how many weeks after the end of the financial year is before you get round to looking at those profit and loss accounts? And you say to the client, geez, there was an expectation that the gross profit percentage was going to be around 38% and it's only come in at 24%. That difference is an enormous amount off the bottom line in every business. And telling a client that in late November or December for the previous financial year is far too late. There's nothing can be done. Yet the big end of town realised this many years ago. They do weekly reports. I know, I was the chief financial officer and company secretary in a listed public company, and the whole emphasis was on the weekly reports. In fact, at the end of the month, when we prepared the actual financial accounts for all of our activities, I would go into the CEO's office and say, you want me to take you through the financials for last month? And my CEO would say to me, how does it line up against the weekly reports, Pete? And I'd say, yes, we were within $10,000 or $20,000 or whatever the figure might have been. You know, dealing with a lot of money. And he'd say, okay, that's all right. Because he ran the business on the weekly performance reports. What he wanted was an assurance that the systems that we had in place to do the weekly reports, which did include some estimates, and you might even call them guesses, of certain items, not so much the revenue sometimes, but more particularly with certain expenses, because we hadn't got them bills at that stage. He wanted the assurance that the weekly reports were accurate because that's what the company was running on. And I found out later that a lot of companies do the same thing. Woolworths, Coles, IGA stores. I've done some consulting to some of the IGA franchisees. All want to have a accounting type analysis of the performance for the previous week by about Monday afternoon, Tuesday of the following week. So they can clearly identify where the problems were. That can then assist in having 12-month financial rolling reports done on cash flow, because that's important. That's where the businesses get into trouble. They've underestimated the investment in stock. They got too much owing by debtors. They're supposed to be getting their debtors collected in 35 days, their budget, and they're sitting on 75 days. That's a lot of extra money tied up in a balance sheet item. Businesses need a board of advice or a board of directors to ensure that there's a group of people there who are asking the hard questions. They don't have to be involved in the business, but I think they need to be paid. So the payment for them needs to be factored into the budgets and the cash flow forecasts, obviously. Because if they're paid, they will be on the job. They will turn up having already read the briefing material. That's not an honorary, voluntary job. I don't think it works. People need to be paid. So if they don't perform, you politely, your client politely suggests that they need to go somewhere else. And an annual valuation is very important for every business as it's growing. Now, when a business starts up, its value's probably 2.5 times after-tax profit. It might build up over a period of performance to 3 to 4 times the after-tax profit. It's very difficult to go much beyond there unless they do something different. And what I've just referred to is doing something different. So let's look at why adopting systems similar to a public company, because that's what I'm suggesting. Why are public companies the only ones that are looking at the concepts I've just looked at, the business plan, the budgets, the valuations, the weekly performance analysis? They do it partly because of the stock exchange obligations to continually report any variations that's occurring in the business. To do that, they need to do the things that we've just referred to. But your clients can do the same thing. And my experience with firms that have implemented this strategy is that their bottom line improves also, because this emphasis on analysing what happened last week can really pay dividends in the bottom line profitability. A few years ago, I was consulting to a firm. It was part of a government program that I was a consultant to. And the business, the company, had invented a very good practical machinery group, you'd call it. There was a number of products within what they developed, and they were very much involved in a particular industry. And they rang me one day, the two directors, and they said, we got that big company from overseas we've been telling you about. One of their directors is coming to see us next week. Do you want to come down and talk to them? I was not in the same city as them. Do you want to come down and talk to them? I said, no, I'll leave this to you. You're going to handle this on your own, but don't get over enthusiastic. I don't think that gentleman's going to make a decision, and I don't think you're ready for it yet. Oh, Peter, you got to give us a bit of encouragement. I said, I'm giving you encouragement, but I'm also warning you, don't get too excited that something's going to happen, because I don't think you've done everything. You haven't done everything that we had on the list, which we had this type of documentation. I don't think they believed me that they needed to do this. So a couple of days after I knew the gentleman was going to be there, I rang them and said, how'd you get on with the international visitor? Oh, well, he was very complimentary about our products and where we were going. But he said to us, we're not investment ready for them to be looking at us, because he wanted us to have a more intense business plan. He wanted the cash flow and budget forecasts to go out for 5 years. He wants audited accounts. He wants an annual valuation of the business prepared. He wants us to be able to stack up against a company doing an initial public offer. And I said, did he explain that to you? He said, yeah, we've heard about 10 times after-tax profits has been a multiplier, a valuation multiplier. I said, that's right. And he said, if we do all these things, he'll come back and talk to us again. They might be able to do a deal. So I said, what are you going to do about it? And I'll now tell you the story of what happened. So they took that advice seriously. They set about doing it. They employed a chief financial officer. They instructed the chief financial officer that his main role was to make sure there was weekly performance reports prepared that they could then analyse, that there were an up-to-date business plan, budgets and cash flow forecasts prepared, that he was primarily responsible for the preparation of systems and documenting the systems, making sure people understood the system in every aspect of the business, and that he could recruit some help if he needed it in some of the more technical areas of the business, so that systems were created so the memory was embedded into the business. So they went through this process, and they found after the first year that their bottom line profitability had improved from what they expected. Why? I think it was because the systems were in place. They had honed in their business operations. There was a lot more analysis of the results. They'd also appointed a board of directors, so the fact that 3 outside people were analysing their performance was very interesting. They'd also installed an internal control system, because that was one of the other items that the foreign company had identified. And this improved some of their activities as well. They had audited financial accounts and the annual valuations. And in achieving the annual valuation, they had taken a chart that I had given them on the key components of going beyond the normal average stage that a SME business goes to, and then going through these steps: systems for every process, internal controls, audited accounts. Not everyone wants to do audited accounts, of course. The annual valuation, so that they had started to see, after 12 months, they could see in their mind their valuation was improving. Well, they continued to do this, and after 2 years, another entity came and started talking to them. And when they sat down and talked to them, they agreed to a deal because they really wanted their technology. But they went through the system and clearly explained to them, this is what we've done. We've geared ourselves up as if we were going for an initial public offer. And we're well aware that the average multiplier is 10. And that's what we are hoping to achieve. Now, when I talk to clients, I say to them, I think you need to reduce 2 points off the 10 to get back to 8 when you're looking at a private company, because there is definite benefits in being a listed public company. There's greater scrutiny, there's liquidity, not so much liquidity in the cash flow, hopefully that's there as well, but it's liquidity from a shareholder's point of view. Because a listed public company, there's hopefully the opportunity that a shareholder can sell their shares today and be paid If they sold them this morning, they would have been paid this afternoon or by tomorrow morning. So they can get their money out a lot quicker. Whereas to sell shares in private companies, as you know, can take a long time before the seller gets the money. So the average price earnings ratio, in my opinion, that's utilised to value a well-performing private company is 4 times the after-tax profit. So if a company is earning $2 million as an after-tax profit, the company would be getting valued at around $8 million. But if the company can achieve those other milestones that I've talked about, it would move it, the multiplier up to a figure, I think, of 8. But some people get more because of the way they're developed and also, of course, what intellectual property they do own, and is obviously part of the deal. But even at 8, that's now made that sale value $16 million instead of $8 million. Now, I haven't come across an SME yet who's going to say, that wasn't worth the effort. I think it's a great effort for them to be able to double their money as to what they might have been paid. And the key group in helping them achieve this, I see it as being you, because you've planned early, you've led with strategy, and you're helping your clients create real value that they can cash in when they sell the business. And we need to be aware that many SMEs do not provide for superannuation for themselves appropriately. They plough all their spare money back into the business. Some of them are living on less than the basic wage, according to the Small Business Ombudsman's latest report. Half of them are in all sorts of financial difficulties. But there can always be this carrot that if they've set their business up properly, there could be a reward at the end. The other big improvement that was noticed in my firm that I'm giving you an example of, that I was an advisor to, was that their bottom line profitability improved as well. No one really expected that. They were always making profits, of course, but the bottom line profitability went up. I think it was because of the greater intensity of the analysis of their performance. There was greater intensity of monitoring debtors and their inventory levels. And if variations occurred from what the expectation was, week by week, that got investigated. And if there was a problem there, it got fixed, so it didn't continue to occur. So within the ESS BIZTOOLS system, we have a package for selling a business, which you can subscribe to on a standalone basis if you wish. And your investment will be $330, including GST, for a 12 months upfront subscription. Now, you don't have to buy it on its own if you don't want to. You could subscribe to the 2 packages that it's part of. So in ESS BIZTOOLS, we've got 3 main packages. We've got Starter, we've got Advanced, and we've got Financial Forecasting. And we build up. Financial Forecasting is the biggest package, and it's got everything in it. So you could subscribe to either the Advanced or the Financial Forecasting package if you like. But if you just want to get started, try it out, see if ESS BIZTOOLS has got a wonderful story for you. Well, your investment's only $330. You only need 1 client that you supply the services for that I've just summarised for you to have a very nice return on investment on $300 plus the GST. So if you'd like to know more, please contact us. I hope you do want to know more. Go to our website, please, www.essbiztools.com.au. Click on Packages and Pricing, and then you can click on the Advanced package or the Financial Forecasting package, and you'll find the selling a business in there, or you can click onto the standalone selling a business package, because the standalone packages are also listed there. And you can have a look at it. You can watch a short video and you can make up your decision. If you decide you wish to subscribe, you can click on and immediately subscribe, and you will have access to that system within 24 hours. And away you go. We do have ongoing training programs which you will be invited to attend. So you can also attend other training programs for which you have not subscribed for, but you're invited to attend, because you'll then see what some of these other packages involve. So thank you for your interest in analysing how you can assist your clients to achieve a far better financial result for them from the sale of their business. I hope that our conversation has created some thinking and ideas in your firm that you can use. And I look forward to hearing from you whenever you'd like to have a discussion. Stay safe. Have a great day. Goodbye.